Hello and welcome back. Again, today we're talking about cash value life insurance as our topic. And what do people use cash value life insurance policies for? Well, there are two major life events that people typically get these policies for, and they're both long-term planning. One is for retirement planning and one is for education funding for college for their children. Now, if you go to my sales page of my blog, products.rightfinancialplan.com, you can download my ebook and find out in more detail about retirement planning as one of the components that's used for a cash value life insurance policy. I talk about that in some detail and in some depth. But what I want to focus on here today is the second plan that people use policies for, and that is education funding. Now, as some of you may know, and some of you may already have this type of a policy, education funding primarily is done in this country through what's called the 529 plan. That's a government-sponsored college funding plan, like an IRA, which is a government-sponsored retirement plan. It is an umbrella plan that the government has set for people to save for college education, and it gives you the benefit of taking that money out tax-free down the road when your children are ready to go to college. Now, as long as you take that money out for college expenses, the government gives you a free pass in terms of taxation. But what if plans change? What if your child decides to delay college? What if they don't go at all? What if they do something different? And you're in a position where you need that money that you've been saving for 10, 15, 20 years. Guess what happens? You're right. That money comes out and now it's a taxable event because you didn't use it for college education. Let's compare and contrast that to saving money in an indexed universal life policy. Again, remember, as we've talked on previous videos, an indexed universal life policy credits interest based on the upward movement of a stock index. You take advantage of the upward movement, you do not have to participate in those losses. And because it's a non-government, non-qualified plan, the government does not tell you, they do not mandate what you use the money for. So in that same scenario, your child decides to delay college and you've been saving money in this policy for 10, 15, 20 years. They decide to delay college and you need money for whatever purpose. Maybe a life event comes up. Maybe someone gets ill. Maybe you need to take a vacation. Maybe you need to buy a home. Money extracted from that policy is now not subject to taxation. Again, if structured properly, that money comes out tax-free. And then if your child decides to go to college a year or 2 years down the road, you can revisit that policy, take money out, again tax-free, and begin to fund your child's college education. So what's better? It really depends on you, but surely you can see from a tax benefit standpoint, the cash value life insurance policy gives you more flexibility. This is the instrument of true flexibility. Unlike a 529 college plan where there is really no flexibility, you have to take that money and use it for college funding if you're going to avoid taxation.